Let's bring in our own Brian Sullivan for some more analysis here. Brian, what's behind today's jump?
I mean, there's a lot of things there. I mean, it's nice to see a little positive momentum in a sector that feels like the 1970s New Orleans Saints. I mean, you just heard your guest say that nobody wants to talk about energy. Well, let's talk about energy if we can. Okay, first off, there's a few things at work here, and nobody's saying energy prices are up. But we're at 30, we're not at 0, Kelly, and I think that's important. Number one, when you factor in OPEC plus, G20, U.S., you're probably looking at 17 to 17.5 million barrels a day that have been taken off the market. The biggest, fastest global cut ever. The U.S., certainly a part of that. How much has been cut off? We don't really know because we don't have an OPEC that sets quotas. Most estimates are probably 1.5 million barrels a day coming out of the United States. And with CapEx cuts, capital spending cuts, that's likely to fall again. The big thing that occurred, as we all know, a couple weeks ago, that fear of the tanks topping, running out of storage that sent that contract negative. That has been relieved. The tanks, they're still full, but they're not overflowing, and that has provided storage relief. And why aren't they overflowing? Because we're driving again. Look at this chart. This is the national. I like to look at sort of the city chart, but this is America in general. Mobility, red, driving, orange, walking, purple, mass transit. Look at the red. It is creeping back up to the baseline of where we were. Not as many people are commuting for work, Kelly, but mass transit still very low. We've talked about it. I believe you see used car sales take off. It's happening in China. Everyone's going to drive if they can. No one's going to be on mass transit. So gasoline demand has started to come back aggressively. Speaking of demand, U.S. producers, they are reducing supply massively, and they're doing that by cutting off future supply. Oil rigs, we talk about the rig count on your show every Friday at 1 o'clock. I want to reiterate these numbers, how dramatic they are. A year ago, more than 800 operating rigs. Today, below 300 and probably going lower. So, Kelly, we have increased demand, reduced supply, and everybody getting back behind the wheel at least a little bit. That helps.
No, the easiest indicator of this is, driving back and forth in the office every day, and it takes longer and longer, and there's more and more traffic. I've heard even this idea from a lot of people who follow the auto sector about whether this will spur new car sales or obviously used car sales. Just the idea that people don't want to do ride sharing. They don't want to use mass transit. Now, that would have a net kind of neutral effect on gasoline demand, I'd imagine, but maybe a hopeful sign for those who are in the business of selling cars.
Well, I'll give you an anecdote. I've been talking about this for a couple of weeks now because my buddy owns a car dealership in New Jersey. Sold 61 cars in the last 10 days. A normal month is 60 cars. So he actually did more cars in the first 15 days of May than all of May of last year. It's a new car dealership. But one guy, he's booming. Other car dealers we've talked to, they're doing well as well because people want cars used or new.
Yep, and we're going to hear a lot of stories about the stuff that's not coming back. So we always have to remind ourselves there's stuff that is or that might benefit.